Hello class! I hope you all had a very nice first week. Before we start today's lecture, I would like to talk about a couple of things first. First is our week 1 survey last week I asked you to submit. As I mentioned when we went over the syllabus, and we are doing a weekly survey to make sure that you're engaged in this class and finish required activities each week. Our week 1 survey's response rate is about 72%. So that is around 37 students and did not finish the survey. I'm not sure and whether for those 37 students, whether you finished all the course material but forgot to submit the survey or you did not finish the required task. Just a reminder, and finishing survey itself is also counted towards your grade. So make sure that you finish the weekly survey and before the deadline by Sunday midnight every week. For those who submitted survey in the first week, pretty much all indicated that you finished all the tasks. And for week 1, a couple of you said that you still haven't obtained a copy of textbooks yet. Just a reminder, the first one, Lyrics, is a downloadable free textbook. So just follow the link to download. This week, we have assigned readings in the textbook, so make sure that you at least have the Lyrics open source free one this week. The other thing I would like to explain is how lecture material will be posted. In week 1, 3 formats of lecture are posted, a video, a narrated PPT, and a PDF with notes, all delivering similar content. The latter two formats, which are PPT and PDF, are relatively small in size, so I don't believe there's much issue in loading those two files. However, some students mentioned to me that the video was loading extremely slow in Learn. To solve this and going forward, videos will be posted in 2 ways as well. One is a compressed file that you can watch directly from Learn. And this file is low in resolution but smaller in size to ensure faster accessing Learn, because we all know that sometimes Learn can be annoyingly slow. The other format of the video is a YouTube link and to give you access to a higher resolution video. So if you're abroad, I know some of you probably don't have access to YouTube if you are abroad somewhere, and so you can access the low resolution video directly from Learn. Otherwise, you can use the YouTube link, and that is much faster and with a better quality and the video. Hope by using different alternatives, and this can give you a better and faster access to class material going forward. Today we'll cover the first topic, common types of accounts on financial statements. First, let's look at accounts included in an income statement. Sales is usually the very first line in an income statement. Sales and revenue refer to the same thing on the income statement, and that is the money you generated by providing services and goods to your customers. But I want to clarify between two terms, which are gross sales versus net sales. So net sales are the gross sales after deducting sales return and sales discount and allowance that entity made into customers during that particular accounting period. So net sales truly reflect how much revenue is generated by the firm, and not the gross sales. So that's why, and we care more about net sales on your income statement. So let's look at example of sales on the slide. So on the right hand side, and you have example of the first couple of line items on your income statement. And the first is your gross sales, and that is pretty much, and do not consider any return or discount, and which is $1 million. And then customer may return their products to you because of whether there's a faulty products or they're not satisfied with it. So which is $50,000, and you notice that they are in parentheses, so that means that should be an item deducted from your revenue. Discount and is $100,000. That happens, and when customers buy something in bulk, so you give them a certain discount and to encourage and like a higher volume. So after deducting sales return and sales discount, and your net sale is $850,000. So in the income statement, so like our example here, and you might see the entity and presenting total gross sales and then sales return, sales discount, and total net sales during that period. This is to ensure that the users of financial statements and clearly understand the performance and of the entity compared and to its competitors. So for example, what is the percentage of sales discount and over gross sales, and to see and how much discount they usually give to their customers. However, and some entities might not show this much detail, but only present the net sales, or sometimes they just call it sales. So if you only see one line item on the income statement, say sales, you will need to know that this is the net sales after deducting returns, discounts, and allowances already. So that is kind of like the actual payment received and from customers by this entity. So net sales and equation is equal to gross sales minus sales discounts minus any allowance and returns and you have from customers. On the income statement, cost of goods sold, or COGS, that's what usually we call it, and are usually below your net sales. So these are all the direct costs and related and to the sales during the accounting period. Depending on the nature of a business, cost of goods sold reflects different types of cost. For a retailer, cost of goods sold is the cost of goods purchased for resale. So for example, and Walmart usually purchase directly from manufacturers. Assuming Walmart's purchase price of milk is on average $2 a carton, and the average freight to ship one carton of milk to store is 10 cents. So all these are kind of like an average cost per carton. We know that Walmart does not buy things Walmart does not just buy one carton; they buy like probably 10,000, 20,000 cartons, and but here we just use average price to reflect the cost. Then the cost of goods sold booked on Walmart's income statement for each carton of milk would be this $2 and of purchase price plus the 10 cents of freight in. So this is the total cost of goods sold per carton for the milk. This is for retailers. For manufacturers, and the cost of goods sold usually are more complicated because it includes many different items. It includes expenditures on raw materials and worker salary and depreciation cost of machine. So we'll talk about depreciation and cost and later in more detail. This is not a very easy concept and to understand. So what does it mean and how we can calculate and to reflect it on the income statement. But we're going to cover this later. Right now, you just need to know that depreciation is certain expenses and you will see on the income statement. COGS also include other manufacturing expenses for manufacture. So this is for cost of goods sold for manufacturers. All this costs add together is the cost of goods sold and for manufacture. For example, and if you are a manufacturer of chairs. So then you will have cost on wood, nails, paint, and other material. And you will also have salary workers and who make chairs. Also, making chairs require machines, and the depreciation of machine is the item reflecting cost of using machines. So for manufacturers, and the yearly cost of goods sold is a very key account, and on the income statement you need to put a lot of emphasis and to analyze it. But this is not always true for all businesses, and for example for service providers. So service providers, and likely, and its cost of goods sold is zero. And for example, if you open a design studio and provide designing services to your client, you and probably other designers you hire are the key resources in providing these services. No other physical material is directly related to generating the revenue. So that's why, and there's no cost of goods sold and on your income statement. So if you look at the example we have here, and which is Liberty Medical Group, this is a service provider and of providing medical services. If you look at its income statement, it has sales about 8 million, 7.7 million, and in both years. And when you look at cost of sales in both years are zero. So that's because, and it is a service provider. It doesn't really have direct costs related to providing this service. And the salary and of its employees or staff are actually booked as operating expenses and on the income statement, which we'll cover shortly. Then below cost of goods sold, and you will see a bunch of accounts. And when you look at here, it actually has a name. It's called operating expenses. When you look at operating expenses, you have a lot of different items below it: selling expenses, administrative expenses. So operating expenses actually and has another name, which is called SG&A, and it stands for selling, general, and administrative. So it's kind of like catch-all expenses that are related to your operation. So for a company and who is conducting research and development, R&D expenses usually are booked under operating expenses. Then you have advertising, marketing expenses. If you rent an office place and you need to pay rent as well, this is also part of operating expenses. Then the utility you're using, salaries of office staff. I also list depreciation here, if you remember, and we also have depreciation and in the cost of goods sold. So the reason why depreciation may be in under operating expenses or maybe under manufacturing cost of goods sold is because it totally depends on what property and this depreciation is coming from. So for example, if a company owns the building where its office is located, so that means this company does not need to pay for the rent. However, that doesn't mean and certain expenses reflecting the rent shouldn't be on the income statement. So instead of having an office rent, and there will be depreciation of the office building on the income statement. So in this case, and this kind of like similar to what you will see rent that company pays for. So that's why depreciation here is considered a part of the operating expenses. So again, and we'll talk about more about depreciation and when we talk about income statement in our later lectures. So now let's look at this example of income statement. So you can see that it's clearly composed two sections. The first section is called operating section, which includes sales, cost of goods sold, and all this operating expenses. And the second is called non-operating item section, so which is below the operating income. So you have non-operating expenses and revenue, and then finally we got the last line of item, which is net income. So the operating item section disclose information about revenues and expenses that are a direct result of the regular business operations. For example, if a business manufactures sports equipment, then the operating item section would talk about the revenues and from manufacturing the sport and equipment and the cost of goods sold related to producing the sports equipment, and also operating expenses related and to this operation, to this particular manufacturing activities. So the non-operating item section disclose revenue and expenses information about activities that are not tied directly to a company's regular operations. For example, for that particular sport equipment company, if that company has, say, 5 factories and all over the world, and then one of the location and has been having loss for 5 years. So then this company decided to close that particular factory and sell it and to somebody else. So they sell this factory and to probably a local business, and then they collect the money and from the buyer of the factory. So this revenue is considered a non-operating revenue, selling the factory and also equipment and from the factory. The revenue from that is considered non-operating revenue because it's not directly related to the main operation of sport equipment manufacturing. It's actually considered selling an investment and to somebody else. So then this would be booked as non-operating revenue and in this section here. Also, if a company and needs a loan from a bank and they borrow money from the bank and pay interest expenses monthly, and the interest expense is also considered a non-operating expense because that's not directly related to the operation that business has. The non-operating section includes different types of non-operating income. Non-operating expenses, also income tax paid. So now let's talk about common accounts on balance sheets. So balance sheets compared to income statement is less straightforward, and we'll only introduce the common types of accounts here, and so what's the meaning behind it and how to conduct financial analysis on balance sheet, and we'll do that later and when we get to that topic. So balance sheets include 3 segments: assets, liabilities, and shareholders' equity. So each of these 3 segments of the balance sheet have many accounts within it. So we'll look at asset accounts first. So assets, as we already covered in the first week's lecture, assets are resources that have future economic benefits to the business. So business can use assets and to help it generate future income. A separate account is established for each asset. So the most common asset accounts are cash, account receivable, inventory, prepaid expenses. Then we have land, building, equipment, furniture, and fixtures. So usually the last 3 items we add together and called PP&E. So we'll talk about this in a short way. So usually the top line of a balance sheet is cash, or sometimes called cash and cash equivalent. So cash is pretty straightforward to understand, right? So it's just the money in the forms of currency like bills and the coins. So the cash we usually see day to day But for accounting purpose, other than that, cash also includes demand deposit that can be withdrawn at any time. So, for example, a company has a checking account with a bank. So at any time, and this business can withdraw money and from that checking account. So the money in the checking account is also considered cash. Cash equivalents are investments that can readily be converted into cash. So the investment must be short term, usually with a maximum investment duration of 3 months or less. So, for example, you have like 3 months bill that can be sold quickly and on an open public market. So that means when you sell the bill and you can have the cash payment right away, and so then it can be quickly converted into cash. So that is considered cash equivalence. So the liquidity has to be very high. Accounts receivable is another type of short-term asset on the balance sheet. So it's a current asset. So we'll talk about what is a current asset later, and we'll talk about a balance sheet. So account receivable probably is one of the most important balance sheet accounts in financial analysis and to help us understand the business operation. So whether the account receivable of this business is high or low compared to its competitors, what does that mean if it has a high level account receivable or low level account receivable? Account receivable is the amount of goods or services delivered or used, but not yet paid by customers. So account receivable is what customers owe the company and not yet paid. Account receivables are created when a company lets a customer purchase their goods or service on credit. So for example, in commercials, and you may often hear the words, buy now, pay later. So that's kind of like a try to encourage you to purchase their products. So this is pay later thing is actually the credit the stores and the retailers extend to you. So the pay later amount will turn into account receivable on that particular retail store's balance sheet as customers do not pay when they receive the products. It could be a bed, it could be some electronics, a refrigerator. Customers already have it at their home and start using it, but they don't make the payment. So the money is actually booked as account receivable on the retail store's balance sheet. Inventory is also a company's asset. So it's the goods available for sale or raw materials used to produce goods available for sale. What does that mean? So that means, and for different types of business, inventory also reflects different things. For example, goods purchased by retailers that are not sold to end customers yet are assets to the retailer and booked as inventory on its balance sheet. For example, you are selling chairs. Again, we are using chairs as an example. You purchase 100 chairs and from a manufacturer. Now your inventory increases by the amount of 100 chairs worth of value. So that 100 chairs become your asset on your balance sheet as inventory. On the first day, you sell 10 chairs. Your revenue increases by selling this 10 chairs. Your cash also increases because you're collecting payment from customers on these 10 chairs. But inventory decreases by 10 chairs. So your asset is lower, but your revenue increases. Your cash also increases. So if your business is going well, then your inventory decreases as you sell more chairs. And at a certain point, and probably you are approaching out of stock, you need to purchase again. So then your inventory increases again. For a manufacturer, inventory is more important and also more complicated. And it not only includes finished products for sale, which are the products they already produced but not sold and to customers yet. They put it in their warehouse. It's considered part of their inventory, the finished products. Inventory also includes raw materials and work in progress and for manufacturers. So raw materials are easy to understand. It's kind of material they purchase and to be used for producing something. Work in progress is something kind of like in the middle. It's not finished yet. So for example, for a chair, it's going to be a chair only with 2 legs. So it's not finished yet. And it's not raw material. It's called work in progress. It's also counted as part of the inventory. Prepaid expenses is another common account we'll see on balance sheet. Prepaid expenses are generated when a business making advance payments for goods or service and to be received in the future. So it's also an asset because it can generate future benefit. So for example, if you prepay and salaries, so that means you pay your workers salaries they haven't really earned yet. But it's also asset because these workers in the future and for sure they're going to work for you and to bring and the income into the company. So prepaid expenses may include a prepaid rent, prepaid salary, and other prepaid expenses. And so you may also have such asset yourself. So for example, and if you are renting an apartment, the landlord usually asks you to pay something upfront, right? Usually, let's say 3 months rent upfront. So for this 3 months rent, 1 month is your rent, which is your expenses. If you have an income statement, that will be rent expenses on your income statement. However, for the other 2 months rent, those are considered prepaid expenses or your asset. If you have a balance sheet, that would be your asset on your own balance sheet. Of course, you don't have a balance sheet, but just want to let you know how we can understand and this kind of concept and using your personal experience. Property, plant, and equipment, or sometimes we call it PP&E, are also called fixed assets. This also account. This is actually our aggregated name for several accounts together. So it means they are physical assets that company cannot easily liquidate. So there's some liquidity problem. So for example, if you have land, you have buildings, and you have equipment, you want to sell it in the market to receive cash or receive money, usually it takes time. So the liquidity for those type of asset is not that good. So that's why, and they call long-term assets or fixed assets. Examples of PP&E include machine, computers, vehicles, furniture, buildings, land, etc. Anything that considered physical property and you will have a long life and it's not that easy and to sell in the market. You can see that usually manufacturers have a very big amount of PP&E, and which is property, plant, and equipment. Because for manufacturers, you need to have factory. You need to sometimes you need to own the land and where your factory is located. For sure, you are going to have different equipments, machines, and in your factory. So that's why PP&E actually is a very important item on manufacturers' balance sheets. But for service providers, that's not that important. So think about service providers like a design studio. You don't have it. You may have equipment like a fax machine or a copier. That's it. So it's not really like 50% or 80% of your asset is your equipment or your PP&E. So PP&E is not a major item for service providers. However, it's very important for manufacturers. So that's why when we actually look at financial statements or when we analyze it, we need to know what type of business and that entity is running, because that's really important for us to understand what are the key items to look for on the financial statements. Retailers, manufacturers, service providers, and they're all different. And you need to understand that financial analysis for those types of business are different as well. We look at different types of accounts and on assets. Now let's look at what kind of accounts and you may have on the liabilities side on the balance sheet. So liabilities are debts or obligations of a company that must be paid in the future using assets. So a separate account is created for each liability. The most common liability is accounts payable. So accounts payable are amounts due to vendors or suppliers for goods or services received that have not yet been paid for yet. So it's an obligation as you will need to pay in the near future. So it's very similar and to the idea of accounts receivable. So for example, when a company extends credit to customers, so the company has accounts receivable on assets. On the other hand, the company's suppliers extend credit to the company, so it does not have to pay its suppliers right away. So this creates account payable as liability or obligation to pay in the future. So that means account payable and on your account is the account receivable on your supplier's account. So your account payable and account receivable are created on the same time, but for different business entities. Loans payable are also liabilities. So this is relatively straightforward. So if you borrow a loan and from a bank, then the business has an obligation to pay off the loan in the future. So that creates liability on its balance sheet. We talk about assets, we talk about liabilities. The third segment on balance sheet is shareholders' equity. So this third segment, there are two common accounts that you really see on shareholders' equity. The first is share capital and the other is retained earnings. So share capital represents the investment made by owners into the business. Say you and your friend partner together to open a design studio, and each of you invest 10K into the firm. Then the 20K added together is the share capital on your design studio's balance sheet. So that's your kind of like initial investment from owners. That's your share capital. Retained earnings. We talk about this concept in our first week's lecture. It's the sum of all net incomes earned over the life of the corporation to date. So it's kind of like accumulated net income over years. Also, that needs to deduct the dividends and distribute it to shareholders over the same time period. So retained earnings, that account, actually, whether we have a high value or low value of retained earnings on your balance sheet depends on two things. One is your dividends. So if you distribute all your net income and to your shareholders every year, and so that means and you don't have much retained earnings, or maybe you have zero retained earnings left and on your balance sheet. So the other factor is how much you earn each year. So say you earn 1 million and you distribute 500,000, then you still have 500,000 left for your return earning and that year. Or if you also distribute $500,000 as dividend, but you earn like $2 million that year, so then you have $1,500,000 as your return earnings. So the higher your income, the higher your return earning, and so then the more money you can keep for yourself. for the company. The higher dividends, so that means you distribute it to shareholders as cash or as others shares, then you have less of return earnings and in the firm on the balance sheet. So if we put it in a graph, the equity, shareholders' equity, you have two parts. One is share capital. We talk about this is the kind of like initial investment of owners in the company. Then you also have retained earnings, which is accumulated over years, and how much you earn each year. Then you accumulate it over time. Then it shows up on your balance sheet. So then retained earning depends on dividends and revenue and expenses, because revenue minus expense is equal to your net income each year. So that gives you a kind of like a more visual illustration and what is shareholders' equity. So today we discuss common types of accounts on income statement and balance sheets. Over term, for sure, and you will see this accounts again and again, like a sales and cost of goods sold and account payable, account receivable, all this type of accounts. When we talk about income statement and when we talk about balance sheet in more detail, or when we talk about financial analysis, we're going to see this many times. So I think it might be a good idea to introduce these terms and or definition as early as possible, so get you more familiar and with this accounts and terms. So we talk about income statement accounts and balance sheets accounts and like asset, liability, equity, common types of accounts, and in those segments. What you need to do after today's class. So required readings are posted on this topic, accounting basics. You can start reading after today's class, but the required readings are actually for the entire topic. So we talk about this, and the entire topic we're going to spend 2 weeks to finish. So you have this week and next week. So you can start reading those required readings, but you don't need to finish them, all the reading today. So you have this week and next weekend to do that. So the end of today's lecture and September 15th class. So I will see you on Thursday. So Thursday we'll post a new lecture and also a weekly survey, and will be posted. I will also post some exercise questions and for you to review and finish. The exercise questions is not part of the requirement or grade. It's just for your own practice, because we have homework 1 coming soon. You may want to practice some questions such that you will get ready and to finish your first homework. Okay, see you on Thursday then. Bye, class.